Folks, Dan Frio here with your market update for October 23rd, 2024. So mortgage rates are right here. These are the top 6 programs we use when they're buying their first house. When I post in the morning, because I post an opening bell and a closing bell, the closing bell is the same rates as the opening bell because mortgage rates aren't published yet. What happens is these are the top 6 products people use when they're buying their first house. Okay, Mortgage News Daily, right at the top. They do a fantastic job surveying lenders all over the country. And they ask them 5 questions, okay? These rates consist of a person with these 5 criteria, okay? It's very important, these things. 2 of them I'm going to show you here in a second, but the 3 are this, and these 3 might be you. Your first-time home buyer, it's going to be your primary home, and it's a single-family home. You might be like, Dan, that's me. But the other 2 pieces of the equation are probably the ones that are going to throw you a little bit of a curveball. If you go down through here, these people are putting down 25% because they have a 75% loan, and their credit scores are 780 or above. So if that's you, well, most likely that's what your rates are going to be. If that's not you, I'll give you all my information at the end of this video because I'm a mortgage loan officer. I'd love to help you. So without further ado, let's get to today's news right here. This is the thing that's going to be in the headlines probably over the next 2-3 weeks. And it's because each presidential candidate, they have budgets that really don't address this, and that's causing concerns right now. And it's coming to the forefront. I don't know why all of a sudden, but usually this is a huge political pony here, but no political candidate is talking about it. So the markets are just like, okay, what's going to go on from here? Okay, so here's a learning curve. Okay, remember I kept telling you guys, don't wait for September 18th when the Federal Reserve cuts. We know they're going to cut because that doesn't mean mortgage rates are going to drop. Okay, so here's what's been happening behind the scenes. Okay, right through here. Here's the chart. This is mortgage rates. Okay, you can see right through here, Mortgage News Daily, and then with I think the MBSs are doing Mortgage News Daily and the MBSs. Okay, you go down through here. Here's where mortgage rates were going. Down, down, down. Look at if you look down there, it's the 9/18. That was the Federal Reserve rate cut. Look at the bottom right over my shoulder. And then it one more day, it dropped a little bit to the 19th. And then from there, it's been up, up, up and away. So this basically their rate cut kind of spooked the market a little bit. So let's get over to the economic calendar and show you guys there's nothing today. There's Fed speakers coming out and there's his existing home sales is probably going to be pretty bad. But let's get over to the markets right now to see what's going on. MBSs are down 20 right now. They're still dropping. Okay, that means mortgage rates are going to continue to go up. Don't be surprised if we see 6.9% today. Are we teetering back to 7%? We might be. So that's where we are right now. Now, here's a former Fed official, and he works at PIMCO. And PIMCO's a huge investment firm. He used to be a former Fed official. He still thinks there's 2 rate cuts. So I'm going to show you his video, get his take on the market. He should be in the know, but a lot of the data that we've been getting lately, the numbers are off and a lot of commentators are off. So let's see what he has to say. And then when we come back, I'm going to put a lot of what he's telling you into perspective because what he's going to talk about is what's the neutral rate and what's some other things. So as he's talking, I might be popping in some just captions like this. This is basically if you go to the federal government right through here, Board of Governors of the Federal Reserve System. You can go right down through here, and it gives you basically the statistics right now that we have in the U.S. Okay, so I'm going to go across these real quick because he's going to mention these in the video. So let me go through this part of it. First caption we have right here is this is where the federal funds rate is, right through here. So it's 4.75 to 5%. There's a quarter kind of a spread there in this. So this is what's called the federal funds rate. Federal funds rate is the rate that the Federal Reserve controls. This is the only rate that they control. And then all other like short-term rates kind of pony off of this one, okay? Mortgage rates are tied to a bond, a mortgage bond that doesn't have anything to do with the federal funds rate, okay? So they're going to talk about the federal funds rate. They're going to talk about the inflation rate. Now, they're going to give you 2 or 3 different inflation numbers. The PCE, this is the number 1 inflation gauge that the Federal Reserve monitors. Right now is 2.2%. Okay, there are others out there. Like, for example, if you go to the CPI, right now it's telling you it's 2.44. So let's just, for simplistic reasons, let's just say it's 2.5, but 3%. Okay, so we'll say it's 3%. All right, so then what they do is they come back through these numbers and they say, okay, the inflation rate's at 3. The federal funds rate is 4.75. So there's 1.75% spread between these. And that's what they're saying. We can cut that much and be at net neutral. Okay, so that's what they're going to talk about in this video. So this is former Fed governor, and I want you to see what his take is on the market. So let's get to it. Federal funds, or the MBSs, are down 18 now. We're going to watch this as it goes through too. So let's get to the interview.
With the 10-year hitting above 4.2%, the first time in some 3 months. So what does all that mean for the Fed's November meeting? Now just 2 weeks away. Joining me now to discuss is Richard Clarity. He's the former Federal Reserve Vice Chairman, PIMCO's Global Economic Advisor. Welcome back. It's nice to see you.
Likewise.
Are you surprised by how much rates have backed up since the jumbo cut?
Well, I'm not surprised in the direction. You know, it's been our call for some time that the curve would steepen, and so we've seen a steepening. You know, it's mostly driven on the real side of the curve. It's not really so much about people worried about inflation. And obviously, we've had some pretty good growth numbers too, both the employment data and then the revision to the GDP data. Now, you know, getting it down to the basis point is tricky, but the direction of travel, I think, makes sense.
Do you think it's going to continue?
Oh, well, I mean, you know, I think it will be data dependent to some extent. And obviously we'll hear from the Fed in a couple of weeks. And obviously people are positioning for various election outcomes. So I'll reserve judgment on that till we have a little bit more information.
All right. Well, what about judgment on how many cuts we're going to get for the remainder of this year?
Our baseline is still that we get another 50 basis points, 25 at each of the next two meetings. You know, coming out of that September Fed meeting, markets sort of were getting ahead of the story a bit and pricing in more than that. I think the recent data and Fed speak has brought market pricing pretty much into alignment with what I think they will do. They're going to take it meeting by meeting. But Scott, I don't think they would have moved 50 in September if they thought that's all they needed to do. So I think a couple more cuts this year would still be the baseline.
Well, let me ask you this. Why should they cut twice? Especially if they're coming to the realization, which I think is true, that the neutral rate is higher than they once thought it was, and that they're not as restrictive as they thought they were either. We cite Atlanta Fed GDP at 3.4.
Yeah.
I don't know whether that pans out to that number or not, but it doesn't matter. The point is that the economy's stronger than they probably thought it would be. The neutral rate is undoubtedly higher than they thought it would be. Why should they cut twice?
Scott, I think they've made they have the judgment. I think the minutes confirmed this. And indeed, the chair referred to the initial 50 basis points as a recalibration. I think you are correct. There's a range of views on the committee about neutral, and neutral could be higher than most people on the Fed think. But I think they all agree that wherever it is, it's below the current setting of the funds rate. So I think there will be agreement for a pretty broad range of data for another two cuts. But I do think as we go into next year, I do think they'll be generally data dependent, and whether or not we get the cuts that the dots indicated will really depend upon what happens in 2025.
Well, what's your own view, though, on this neutral question and what it means for policy? Because it's potentially significant, right? They may feel like they have the luxury of not cutting twice, and they would explain it by, look, the economy is strong enough that we don't need to. Obviously, we don't want to reaccelerate inflation in a way that would be punitive to the economy.
Sure. So my own view on neutral is, you know, that the front end of the curve, which is what the Fed sets, the funds rate, I'm more or less in alignment that ultimately once inflation gets to 2, that a neutral rate of around 3% makes sense. Where I do think the world will be different than it was before the pandemic is I think we'll have a steeper yield curve. So I think part of the way that the bond market clears is not so much with a higher front-end neutral rate, but potentially a steeper yield curve on top of that.
Interesting. Okay, so I hope you understood his take. So when they were talking about neutral rates and things like that, they're saying that basically the spread between these areas here, federal funds rate and the inflation numbers, okay? But then also you have to look at the health of the economy. So if you took out actually the federal funds rate and just looked at everything else, you'd say PCE's at 2.22 or 2.2. It's good. Usually they wanted it 2, but it goes from 1.8 to 2.2, you know, and up and down a little bit. An unemployment rate at 4 or below. Thumbs up. GDP at 3. thumbs up. Here's the anomaly right through here. So overall, this is signaling a strong economy. You guys and me both know it's not that peachy out there. Okay, so this is where they're saying they have room to cut. And I agree that they have room to cut. It's just when, how much, and will it spur more inflation coming. So that's what we're seeing right through here. So let's go to the CME FedWatch tool. It's now telling us there is a basically a 91% chance that they're going to cut 0.25%. So let's think of this way. If they don't cut, now that 90% of the market thinks they will, it's going to completely spook the markets. So they're probably going to cut 25 basis points. We're going to see the unemployment numbers coming out. Let's look at the economic calendar for today and this week. Today, all we have is Fed speakers coming out, existing home sales. I don't think that's going to be a shocker. I could be surprised. And then tomorrow is when some of the data comes in. What we're going to be focused in on mainly is the continued jobless claims and initial claims. This is going to tell us, but this number is going to be skewed. So if it's really bad, they're going to say, well, the hurricane, it could have, big fluctuations on the jobs or numbers. You had strikes, you had a whole bunch of other things. So my thought on this is going to be kind of a mixed bag of numbers. It might show more negative than we expect, but the Federal Reserve, when they hopefully, but the market's going to react saying, okay, we had the hurricanes, we had the port strike, we had the GM strike, we had this strike, that. So, are the jobs numbers going to be skewed? That's my concern going forward. But if it's a number that looks worse than expected, that means the Federal Reserve will go in and cut. But again, once again, we go over to this chart. Just because they're cutting doesn't mean mortgage rates are going to go any lower. So that's what we're going to focus in on, and that's what I focus in on every day to tell you guys where the markets are going. We talk real estate. The real estate market right now is, I'm going to say, just completely stalled out. People are sitting on the sidelines. It's that time of year when a lot of people don't buy anyways. We're hitting the holiday seasons. Yeah, believe it or not, we're hitting the holiday seasons. So a lot of people just put it off until next year at this time. So there will be still some buying this year. We're going to see how that goes. There's going to be slim pickings on what you can buy, but there's also going to be slim pickings on the number of people looking to buy. So that might be play in your favor a little bit. So my name is Dan Frio. I do this report every day. I'm actually a mortgage loan officer. I'm licensed in all 50 states. So if you're out there watching this, doesn't matter where you are, I'd love to help you. Okay, so if you're looking to buy that first house, I got to move this down a little bit. I'm losing some stuff at the top. Oh, nope. If you're looking to buy a home, maybe looking to refinance, maybe you're looking to buy that first investment property. We have a lot of people doing that right now, that and second homes. It's kind of weird. But if you're looking to buy your first home, what I need you to do is check out the Grant Finder right through here. Okay, it's going to give you national programs. There's 3 of them that we handpicked. Then they're also going to give you grants in the Chicagoland area. The nice thing about the grants in the Chicagoland area, it'll give you $10,000. Yep, 10 grand to use toward your down payment and closing costs. Check and see if you qualify for that. And if you want to apply or at least talk to somebody, well, click the Apply Now button and you'll be on your way, because you can set an appointment in there as well. But if you'd prefer to call us, just scroll down to the bottom and you're going to see all our information right there. So our 800 number is 844-775-5626, or you can reach me personally. Yes, it's me at dan@therateupdate.com. So thanks so much for watching, guys. We will be live today at 2:30 Central Time. And I think today's topic, we're going to talk about down payment and down payment assistance, where we're going to show you guys how to use this tool on our website right up through here. You can start your loan, or actually tell us what rate you want. If you're looking to refinance, you can tell us right through here. So if you're looking to refinance, we have a system called RateWatch. But if you're out there and you're like, hey, Dan, I'd like to apply, just click the Apply Now button and you're on your way. So thanks for watching, guys. I'll see you back here at 2:30 today for our live event. Take care.